How you doing, guys? This is Carl Dean. I am the managing director of American Real Estate Investments. As you can see here, I got my career started in Michigan, where I was at an early age flipping homes for investors, doing the rehabs, putting crews into homes and having them rehab for investors that were purchasing the houses, purchasing the houses. And I quickly learned the investment side of the business and got a real estate license, then followed by a broker's license. I've done a lot of different things. I've had a custom design company. I've built homes myself. I've had a nonprofit foundation for animals. I'm just a pretty busy guy, and I like to stay that way. So, you can kind of see my history here. Feel free to look me up on LinkedIn just to kind of give you a little bit of credibility. Um, Enough about me. So we are doing. You can see here. I've got quite a few different endorsements here. Anyways, our webinar today is the truth about net yield. So I'm going to start this thing here. Now, I'm doing this for a lot of my business-to-business clients because I talk to these guys and they say, Carl, I would love to sell your assets. They look great, they smell great, they feel great, but I just cannot get my investors or my clients or my students' head around the fact that these are much more expensive assets. Everybody is chasing the low-hanging fruit. Everybody seems to want that $75,000 asset with a 15 cap or, something that's just really not going to be a sustainable investment for the long term. So I myself made the turn, as did my company. I am the managing director, as I said, so I kind of control the pace of the company and what we do with our assets and what we do with the capital that we do spend in the market. So I chose to come down to Texas and attack this market because it's a really fast growing market. It's got a lot of good appreciation, and to me, it just made the sense as far as the long-term investment. And I'll tell you why, but we'll get into that. So let's check this out. So I'm going to break this down for you, for those of you who may not understand anything about investing, because I don't know who's going to be watching this or what your experience is with investing. So just to keep it very simple here, breaking down the yield, which is what an asset can produce or provide. In the case of homes, it would be the amount of money that you could get for rent for the year. So your annual yield would be the amount of money totaling all of your rent payments that you took in for the property. So your net yield is going to be all of that rent you took in for the property minus all of your expenses that you had. So there's a lot of different expenses on properties, especially if you have a property manager. You have management fees, obviously. You have your taxes, and you have your insurance. Those are all considered hard costs. And there's some soft costs as well with maintenance, vacancies, things of that sort. And we'll get into that a little bit more as we go forward here. So giving you a quick breakdown to kind of do your formula to find out what your net yield would be on a property. Okay, so if you see a property, this is a very simple understanding of how you could break down and figure out what your net yield is going to be. So you take your rent, you times it by 12, obviously, 12 months in the year, and then you're going to get your gross annual rent. That is, the gross annual rent is going to be before any expenses. Then you'll minus your taxes, you'll minus your insurance, and you'll minus your management fee. I pay 8%. Some people pay 10%, but we do a lot of business in a lot of different markets, so we have great relationships with a lot of property managers, and they tend to give us good deals. And then you also minus your assumptions, which is looking like 2%. So this particular home happens to be an A-class asset that we have, and we only take away 2% because we usually sign 3-year leases, and the tenants are stellar. Our rehabs are second to none, and we really don't have any issues. But we like to throw a little something in there just in case there's a leaky pipe or something. You've already accounted for that cost. So those things are going to equal your net rent. Okay, you got your gross rent, you minus your taxes, you minus your insurance, you minus your management, and you minus your assumptions, and you get your 10.6 or 10.16 net rent. Okay. As you can see here, the percentage that represents things that you assume could happen is also known as soft cost. You'll hear me say things like your assumptions or your soft cost quite a bit in this webinar, and I'm describing the things that are unforeseen, that are soft cost. You don't know for sure if you're going to have them, but you're thinking about them, that you could have them. You're assuming you could have them. So I'll use the word assumption a lot probably. So if you hear that, that's kind of what that means. So after you know your net rent, you simply divide that by your purchase price to get your net yield. So in this particular situation, this person bought the house for $135,000. You divide that, or you divide the net rent by that, and you come up with 0.075, otherwise known as 7.5%. So this house particularly has a 7.5% net yield. So what are the things that investors are scared of, or what are the things that really take a good investment and turn it into a bad investment just because you didn't predict that they would happen or something came up? That is called the assumptions. Also, soft cost. I'm going to stick with assumptions because that's kind of my little slogan or key term that I use a lot. A lot of people say different things. My thing is the assumption. So when you assume it could potentially happen, I consider that an assumption. So what are assumptions? Things like vacancy due to bad tenants, break-ins while vacant due to location. So if you're in a bad area and you have a vacant home, 9 times out of 10, that home's going to get broken into because people know it's vacant. And even if you do security measures such as boarding up the windows or doors, that's almost like a red flag to let them know and verify, hey, this is an empty house. Unexpected repairs due to poor rehab quality, and also the snowball effect. So the one you definitely do not want to deal with is called the snowball effect. And that is when you kind of have all these things trigger at the same time. So a vacancy due to a bad tenant. So a tenant can't pay their rent and they move out. Do they tell you they're moving out? No, they don't. So what happens? The house sits vacant. The management company doesn't know. And so for 1 to 2 weeks until they decide to go check on that home, which they don't do often unless the rent is not showed up, they're going to find out that, oh, wow, well, this home was sitting for 2 weeks and it got broken into. Okay, that breaking into, or that robbery, or whatever you want to call it, is going to cost you many, many dollars. Okay, so that is usually going to add up expenses very quickly because they're going to take anything in the home worth money. And I mean, they take globes, lights, faucets, hot water tanks, furnaces, copper, anything they can get their hands on. I've seen them bust the walls open and strip the wires right out of the walls for the electrical. I mean, it's bad in some of these C-class areas. So what happens is, while you're sitting there and trying to negotiate with your management company on why this happened, what was the big deal, who dropped the ball, what happened here, the home sits even longer. The grass gets longer. It gets overgrown. It's not being taken care of. You're arguing your point, trying to get your head around what happened. And what happens is the snowball effect. Things keep getting worse. You keep getting leaks. The windows are broken. It rains inside. Now you've got mold inside your house. It's a snowball effect. So we try to avoid that stuff. And the best way to do so is really just not buy properties in these type of areas, because the snowball effect is all initiated by the first step, which is bad tenants. Bad tenants move out without telling you. Homes get robbed. They get broken into. Things get stolen. It's sad, but it's true. This is what a C-class market involves. Very, very high risk. So I say to a lot of people, beware of the Mirage. Why do I say that? Because you see these brick homes, and this is very famous with a lot of investors, and I've heard so many sob stories I could bring up. And I'm not one to pin down people and say names, but there's some firms that were over in Australia that were just selling Detroit properties and St. Louis properties that were just no shape to be sold. I mean, they were just, they prettied them up for pictures, put tenants in them, and sold them for $50,000 at a 15 cap net. And when I say cap, I mean yield, the same as a yield. 15% net yield at $50,000. So people were like, wow, that's unbelievable. Detroit, the housing market in the U.S. is crazy. I'm getting on board. I'm putting some money over here. A $50,000 asset to an Australian or a South African is not really a lot of money. So that's something that they go at, well, compared to their homes at least. So that's something they go after. And when they go after it, they soon realize that, regardless of what this thing looked at like on paper, it was what I call a paper yield. So it's fake. It doesn't mean anything. You're getting a bad tenant in a bad neighborhood, and no matter what, it's like, regardless of what it looks like on paper, that tenant is probably a Section 8 tenant. You're probably going to have issues with the tenant. They're probably not going to be, wanting to take direction or listen to a property manager. They move out without knowledge of doing so, or without letting anybody know. So what I try to do is avoid purchasing these properties, because I don't like to deal with the tenants with less than stable jobs or less than stable income. I don't like Section 8 tenants because when you have a Section 8 tenant and something goes wrong in your property, well, at that point, you are responsible to fix it. And if you don't, then Section 8 is going to take the rent and they will no longer pay the rent and ask the person to move out and into a new home. That's kind of a catch-22. So you put a bad tenant in a house, they're not responsible for anything, so they don't care. The government's paying their rent, so they're all there all day with their kids, and they destroy the home. So when they destroy the home, their government Section 8 worker comes back out and says, hey, they destroyed all these things. Well, you need to fix somewhere else. They're not going to be able to stay here. Well, that's a bad thing. That's not a very good thing at all. It's not something you want to hear because it makes you feel trapped. So I try to avoid that. So I would definitely advise anybody to try to do the same. And that's, like I said, just stay away from those assets. Okay, so what we have here is an exact C-class asset example that I pulled from our inventory. Obviously, I blacked out the addresses. So you'll see in the sales price column here, the sales price to the client. Now this is your Zillow value here, or estimated value. And you can see with a lot of the C-class assets, because you're purchasing them off of a yield, the yield is going to show the value of the home higher than the actual estimated value or BPO value from an appraiser or a broker who knows what they're doing. You can see the one here is sold for $35,000 and a BPO saying it's only worth $26,000. So this isn't something that you'd be able to refi. This isn't something you'd be able to get a loan on. This is why they sell those assets in cash. So the first year assumed expenses for C-class assets is 15%. And as you'll see right here, we totaled in the 15% for these assets. You got $2,000, $1,400, and $1,200. That's assuming that amount of money is going to be used to, do repairs or cover vacancy or maintenance or loss or any kind of different things that you could assume would happen. So, sorry about that. As you can see, it says here in the standard formula to calculate the net return, it is assumed 10% for maintenance and 5% for vacancy. In a perfect world is great, but C-class assets is never a perfect world. So these assets were purchased by the investor under the assumption that they were going to perform at a 15% net cap or net yield. And that's clearly not the case. So when you look at the actual performance for these assets for the first year, you're going to see that the snowball effect on every one of these. This may not even have been the snowball effect. This could have just been a bad tenant who destroyed some stuff. House had to be painted, some broken windows, whatever the case may be. Maybe some foundation issues or something. You never know. I mean, it's hard to tell what these expenses are. I don't have it in front of me, but you can see this $25,000 one, the $16,000 one. Those are definitely issues that you're going to say were a cause of the snowball effect, where a tenant moved out, the home was robbed or broken into, and then it just major issues kept occurring and reoccurring. So something you want to definitely try to avoid, obviously. Those expenses add up very quickly with these C-class assets because the risk is very, very real. And that's why I put high return means high risk. Okay. So now I have an example here of some of our A-class assets, which is a dream world for me because I just love them so much. The reason I moved our entire company down here to Dallas, which is where we're headquartered now. We got guys from Jersey, we got guys from Kansas City, Michigan, San Diego, we're from all over the place, but everybody moved to Dallas because there's so much going on in this real estate market, and it's such a solid market to be in, that it just doesn't make sense to not have my guys here. I mean, this market is like nothing I've ever seen as far as the growth. I mean, Phoenix was there for a certain point in time some years ago, had a tremendous amount of appreciation and growth. Now, Texas has Dallas, San Antonio, Houston, Austin, Fort Worth. Those are all in the top 10 fastest growing cities and economies right now, according to Forbes magazine. So going through this, so you have a Houston, a Dallas, and a San Antonio example. 2% assumptions, assuming that you may have some issues here with these properties, okay? And the investor purchased them at a 7.43% net yield. Now, the actual performance for these assets the first year had no issues, not one. So, you're assuming, oh, this could happen or that could happen. You're being a little conservative there, and nothing happens because they're just good assets. They have great rehabs, they have great tenants, and there's not an issue. Those tenants could be corporate relocation tenants. They could be tenants that own two houses and have investments of themselves, but their work just so happened to move them down to Houston or Dallas, and corporate relocation programs that we work with our property managers put them in our assets. And they do that because these are assets that anybody would want to live in. They're in great school districts, first time homebuyer neighborhoods. They have great exit strategies. These are homes that anybody would like to live in. I would live in them myself. But so you have zero expenses here. So let's go even further and look at with the appreciation being what it is. And I think I used 10% here just to show you. Um, you know, you look at these rents, okay, compared to these rents, after 1 year, that rent increased 5%. So you went from $1,300 rent to a $1,365, $1,400 rent to a $1,470, a $1,200 rent to a $1,260. So instantly you're getting more rent and they're performing higher. Oh, I forgot to say, obviously, because these here had no assumptions. Now your asset is performing a point higher. Okay, so you're at 8 points, almost 8.6 versus a 7.4. So then on top of that, you get to raise your rents because of the appreciation, and also the original purchase price, and now the value of the home after 1 year of appreciation is increased by 13,000, 14,000, and some change, 12,005. So altogether in 1 year from owning 3 assets, you had $40,000 in positive appreciation. Okay, that's equity that you could refinance your homes for, take out, and purchase another home. Just trying to put into perspective, not only are they low maintenance assets, but they're also assets that are going to appreciate. They're going to be hassle free. You're not going to have to worry about them. You're going to be able to raise your rents. You're going to be able to have credible, good tenants with great jobs. And, at the end of the day, when you up your rents and you don't have any of the assumed expenses, you have 3-year tenants in there. Now you're up here. Now you're in the nines. So a 15 cap, that's on paper, great. Yeah, but then you have all the risk associated with it, and then it takes you down into the negative. Or you have something that you purchased at more conservative 7.5, and actually performs at over a 9 in just over a year. So just trying to show you an example of that. So do your research. This is just my little slide to remind you to do your research. So there's a lot of sites out there. Some are good, some are bad. Do not rely on one site for all of your information, because some sites are good at some things and terrible at others. So I know this because I used to research, underwrite, and do a lot of due diligence on a lot of properties. More so my team nowadays, but at the same time, they learn from me because I've done it for so long. So do not rely on what you're being told by the person selling you a home, especially if they are the property manager and they do both the property management and the investments. If you're buying from a property manager, that's a red flag, because that person has an interest in some other portion of that deal. Okay, Trulia is a great tool to check the neighborhoods as far as crime. So you'll be able to check on Trulia, go down, get to the crime, and you click on the crime in the area, and it'll show you all the recent crimes. You can even double click it on the map and get a little closer up just to see if your particular street that your home is on has any issues. That's a great tool. We use it on every one of our properties. I actually have my guys put a Trulia crime link in my spreadsheet when they send it over. Also, the school district ratings. So this is something when I sell to hedge funds and publicly traded REITs, they all ask me for the school districts. And there's usually a rating for the elementary, the middle school, and the high school. It'll be 3 different numbers, 778 or 889 or 443. That's different ratings for the different schools. So, and that's a credible source for schools, but not a lot of other things. The Zillow values are always wrong. The Zillow rents are always wrong. I don't know where they pull their information, but Texas particularly is a non-disclosure state, so they're just making things up most of the time. But it is definitely a great tool to use when you're trying to find out what the school districts are like in the neighborhood, which is a majorly important thing when you're talking about exit strategy and how you want to get out of these assets down the road. You can use Google Street Views. It's a good way to browse up and down the streets to kind of get a feel for the neighborhood, what kind of neighborhood you're in, what kind of commercial is their next commercial property is their next door. Stuff like that. But at the same time, keep in mind, these are typically dated 2 to 3 years. Sometimes they get as new as 6 months, but these are always dated photos. So the street could look better, the street could look worse. So just be aware of that. So I'm glad that you guys sat with me and checked this PowerPoint out. It's kind of something that I'm pretty passionate about. There's a lot of people that I deal with on a day-to-day business wise that come to me and just say, how can I get my clients off of these C-class assets or whatnot into these nicer assets? How am I supposed to pitch this? Well, this is just it. Just tell the truth. It's pretty simple. Show them real life examples of what these C-class assets do down the road. You give me someone who owns 10 C-class assets and show me that what their assumptions were, and then show me what their actual costs were. And I guarantee you, every one of them has a story. Those are very hands-on things. They're not a set it and forget it kind of property. That's only an A-class property. That's only when you have a great tenant in a great neighborhood, great school districts. Those are the only time you can really make sure that you're going to get a good hassle-free asset. It's the best way to really have a passive investment is to buy something that is appreciating, that is a solid newer home, and it's something that you could get rid of if you needed to without having to take a huge hit. It really is a smarter play. So when you have things like financing available for these assets, and for the same amount of money out of pocket, you could buy a C-class asset with. You turn around and leverage it and buy an A-class rental property in a thriving market like one of Texas's markets. It just doesn't make sense to not do that. I get the low-hanging fruit thing. I get that new investors want to kind of key into that and take advantage of those high yields. But at the same time, keep in mind, we're very experienced investors. We're very, very experienced in not only this market, but many markets across the U.S. We've went through the trial and error more times than anybody can even count. And, we've gotten to a place where we feel comfortable letting others know, hey, this is why we do what we do. This is why we're in the markets we're in, and this is what we see going forward. So hopefully this helped you guys, and hopefully you enjoyed it. Until next time, I will give you, I think my next one's going to be a due diligence webinar, talking about the different things we do and look for in the due diligence process and how to protect yourself. So until then, I will speak to you. This is Carl Dean with American Real Estate Investments. Have a great day.